Good morning and welcome to another Morning Markets with True Potential. You've heard from colleagues over the last few days regarding inflation in both the US and the UK. Thought it would be a good opportunity here today ahead of the UK fiscal budget to summarise inflation and the outlook for markets based on the future path of inflation. So recall that yesterday UK inflation accelerated further in both the core and the headline measures beyond market expectations. The story in the US has been different, where inflation that came out towards the end of last week actually surprised on the downside. Now, both the UK and the US inflation measures are still remarkably high, but it is the path of inflation which is both cheering investors globally because of the US and worrying investors here in the UK because of the imported prices from energy prices here. So, one of the reasons for the cheer in the stock markets over the last week has been that deceleration in inflation pressures in the US, which may very well mean that the Fed can slow paces of interest rate hikes from December and hopefully taper off towards no further hikes beyond the end of the first quarter next year. And that would leave interest rates in the US somewhere around 5%. And that's roughly what markets currently expect. So the idea that markets have in some way perfectly priced the path of future interest rates in the US is what's leading to some cheer in stock markets over the last week. That is, that the monetary policy tightening is largely over and that the economy will be left on its own to try and grow earnings as we go forward. Now in the UK, it's slightly different. The price pressures from energy prices globally are still being imported, and that's likely to see pressures on headline inflation here at least through to the start of next year. But then, because of energy base effects, we will likely see inflation pressures roll over in the UK and fall substantially in the second half of next year, back towards somewhere between 2 to 4%. There's a similar story in the job market as well. Recall the jobs data earlier in the week for the UK and also earlier in the month for the US. The story with regards to inflation in wages is somewhat similar to what we're seeing in headline inflation. US wage data for workers is actually cooling and is slowing and is back to where it was towards the start of the year. However, in the UK, it's different. We're seeing wage pressures continue to accelerate somewhat, and they're still moving substantially away from where the Bank of England would get comfortable with. And why is this? Well, the UK is still struggling to find enough workers to fill the vacancies in the services industry. And monetary policy, which acts with a lag, hasn't yet reached a level that is tight enough to slow the appetite for employers to hire fewer workers. So this all brings us to today's UK budget and what it means for the fiscal outlook. Well, it's been well leaked by the government that we're going to see substantial tax rises, probably delayed somewhat towards the end of their forecast period, maybe from 2025, but also severe spending restraint over that same period. The idea of this is to try and bring the projected debt versus GDP profile flat, and then so it's rolling over and falling by sometime around about 2026, 2027. So on paper, there will be a number of tax rises and spending restraints towards the back end of the 5-year forecast. But this, in some way, will limit the interest rate rises that the Bank of England perhaps expect they need to do through next year. And this is already coming through in the UK gilt market. Recall the volatility of the UK gilt market in October, which was what originally caused the quasi-Kwarteng budget to be curtailed. Yields on UK government bonds are now back to levels where they were in September, so before the budget was even announced. And that's largely because the market is now comfortable that borrowing levels from the government will be somewhat more predictable and will not be as large as was originally feared when the Kwarteng tax cuts were originally announced. So that will feed into the Bank of England's forecasts when they next meet in December, and they'll likely deliver another 50 basis point increase in the base rate in order to try and slow these inflation pressures. And we'll likely see something similar from the US Federal Reserve in December as well, as even though they are beginning to cool the rate of interest rate increases, they are still trying to tighten monetary policy sufficiently such that they slow the growth in the jobs market. So we get the budget around lunchtime today, so please do join us tomorrow. We'll give you a full update on the details of that, and also within our weekly podcast we'll discuss that in more detail. Thank you.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.